This line that you see here, moving up and down, shows us one of the most important macro forces for Bitcoin. It tracks how hard it is for companies to borrow money, giving us a direct read on how freely liquidity is moving through the system. This is a concept known as credit spread. When this line rises, investors demand more compensation to lend money, signaling tighter liquidity. And when it falls, lenders become more comfortable, reflecting abundant liquidity and stronger appetite for risk. Recently, this line has been rising from levels we've only seen in 1997 and 2007. In both instances, credit spreads went on to surge aggressively, becoming a key trigger behind the dot-com bubble pop in 2000 and the financial crisis in 2008. Today, companies are borrowing at much higher rates, and lending standards continue to tighten across the banking system. There's also a $1.6 trillion credit bubble building beneath the surface, significantly increasing the risks, something we'll cover later in this video. If we were to see something similar play out today, it would have major implications for Bitcoin. By the way, make sure to take advantage of the discount that we're doing for Black Friday. You'll get access to our entire trading strategy with all of our buy and sell alerts for each trade, where we take you from initiating a position to booking profits and closing the trade. Since the beginning of this year, our strategy has delivered multiple double-digit wins while keeping our losing trades very tight. This is our biggest deal of the year, where you can get access to our full membership for a fraction of the price. We rarely do deals like this, so make sure to capitalize on it using the link in the description below. Think of credit spreads as the market's way of telling us how much risk investors are willing to take on. When a company wants to borrow money by issuing bonds, investors demand extra compensation above what they would receive from US Treasury bonds. That extra yield is the credit spread. For example, if the 10-year Treasury is at 4.2% and a 10-year corporate bond is at 6.2%, the 2% difference is the credit spread. When credit spreads rise sharply, companies face higher borrowing costs, which weakens future growth expectations. But the real damage comes from forced selling because hedge funds and leveraged investors who depend on cheap financing are suddenly hit with margin calls and liquidity stress. That's why rising spreads typically lead to sharp drawdowns in the US stock market. And every time spreads have crossed above 10%, like 2001, 2008, and 2020, it has coincided with episodes of systemic stress that led to an economic recession. Each crisis seemed like an isolated event, but they were all connected by the same cheap credit driving risky behavior. Now, if we replace the US stock market with Bitcoin, a clear relationship emerges. When spreads rise, it coincides with vicious declines on Bitcoin. And when spreads fall, it creates an ideal backdrop for Bitcoin to thrive. The correlation coefficient between the two is around negative 0.6, indicating a strong inverse relationship. So even without rate hikes, rising credit spreads act as a form of hidden tightening, draining liquidity from the system. And we saw this very clearly in March 2020, when the pandemic hit and credit spreads spiked from 3% to 11%. Bitcoin collapsed by 50%. So Bitcoin trades more like a leveraged risk asset during liquidity-driven systemic stress, rather than a safe haven. And credit spreads are one of the earliest warning signals for when that stress is building. Now, we have some good news and some bad news. The good news is that many large US corporations used the pandemic to refinance their debt at extremely low rates when money was cheap. For example, Apple issued $8.5 billion worth of bonds in 2020, with spreads as low as 0.55%. And Microsoft refinanced $4 billion that same year at rates around 0.7%. Companies like these could easily survive a credit freeze today, even if spreads were to spike sharply. But the bad news is that the average US company doesn't look anything like Apple or Microsoft. According to the Fed's data, corporate debt to GDP is still sitting near 45%, a level also seen before the 2001 and 2008 crisis. And unlike the megacaps, much of this debt is floating rate, which means even a small rise in credit spreads not only makes new borrowing more expensive, but it also increases the cost of their existing debt. There's also a larger concern emerging in the private credit space, the part of the market where non-bank institutions lend directly to companies. Since 2008, this market has gone from $230 billion to more than $1.6 trillion, equivalent to about 5% of US GDP. Most of these loans carry floating rates and come with looser requirements than traditional bank financing. The problem is that private credit doesn't show up in traditional credit spread indicators. So while standard credit measures might look stable on surface, they are only tracking the companies that banks and major institutions are comfortable lending to. But the riskier companies that are more vulnerable to rising spreads are hidden in the private markets. An IMF report recently highlighted that banks have become a key source of leverage for private credit firms. If this sector comes under stress, the shock would spill directly into the regulated banking system. This can create a negative feedback loop, as stress in private credit puts pressure on bank liquidity, forcing the banks to tighten their lending, which would squeeze private credit firms further, applying greater pressure on the banking system. Today, 6.5% of banks are tightening their lending standards, as we can see from this chart. But this number has come down significantly from the 51% reading we saw in 2023. In other words, even though some banks are tightening, the vast majority are not, which means overall lending conditions still remain favorable. If we put credit spreads on top of this chart, we see a very close relationship between these two lines. In fact, shifts in bank lending standards have often preceded major moves in credit spreads. So with fewer banks tightening today, credit availability appears to be improving. And if that's the case, then any move higher in credit spreads is likely to remain limited and short-lived for now. Of course, if banks start significantly tightening their lending standards again, we'll be quick to readjust our strategy. But that's not what the data is showing right now. In fact, if we zoom in and replace credit spreads with Bitcoin's yearly returns, we see something even more interesting. When the share of banks tightening lending standards is rising, it coincides with a weak performance on Bitcoin. And when that line is falling, it tends to create a supportive environment for Bitcoin. Since late 2023, lending standards have been easing, signaling that credit conditions continue to favor risk assets like Bitcoin. And as long as that remains the case, we remain constructive on Bitcoin, despite the potential for more short-term volatility. If you have not taken advantage of it, do not miss the massive discount that we're currently doing on our service for Black Friday. You'll get access to each and every one of the trades that we share with our clients. We pride ourselves on being extremely transparent regarding our track record of our winning and losing trades that you can check out on our homepage for free. We trade stocks, crypto, and commodities. This is our biggest discount of the year, so make sure you take advantage of it using the link in the description below.